Howdy, Jacob here. Today we're looking at Shift4 Payments in the professional services industry. 9.3 billion market cap, 10.8 billion enterprise value. They provide software and payment processing solutions in the US and internationally. They offer payment platform and omni-channel card acceptance and processing solutions across multiple payment types. Okay, they provide technology solutions. Okay, founded in 1999 out of Pennsylvania. Headquartered in Pennsylvania at least. Growth in revenue has been astronomical. 561 million in revenue just 7 years ago, but 5 years before the most recent data we have to 2.6 billion dollars. And we're looking at 30%, over 30% compound annual growth rate on the revenue. And we are seeing an increase of gross margin, and they're just starting to be positive on the they're starting to be profitable on the operating margin side, so that's good. Return on invested capital pretty poor, not as much as I would have thought, but let's dig into that some more. Maybe R&D is pretty high. Nope. Cost of goods sold, majority of their costs. Sales general admin also picks up a little bit, and so from a margin perspective, not crazy impressive. Single digits here. Balance sheet shows 455 million cash on hand with 1.75 billion in long-term debt. No short-term debt though. Looks like they issued some debt both here and here. Wonder if that was an acquisition. I'm not really seeing a whole lot of acquisition activity from a balance sheet perspective. There definitely is some, but nothing too big until most recent 2 years actually. So 439 million for acquisition here, 170 million here, 135 million. So definitely doing some acquisitions with their capital allocation and buying back shares. Also doing a little bit of reinvestment as well. And so historically, those are pretty good things as long as they're doing the reinvesting at the most advantageous place. Those are three of the places that can give you the greatest return, but we'll see whether that's the case or not. Let's start making our own assumptions. So for revenue growth here, they're growing like crazy. Makes sense. They are making acquisitions, reinvesting a bunch. But again, when I make assumptions, I assume 100% capital allocation. And here they increased debt by $1.2 billion. And so that's not necessarily using 100% capital allocation. And so I'm going to assume that, their full free cash flow is being allocated towards acquisitions, share purchases, reinvestments, debt, dividend. I think that with a free cash flow of almost 361 million in the most recent year, that is going to be about 5 times that to get to your long-term debt. If they're able to grow as fast as they have, that's not concerning because, again, if you don't increase debt and you increase your free cash flow to debt will go down as your numerator goes up and your denominator stays the same. But I still want them to be focusing on debt reduction in the fact of I want them to be thinking that it does need to be paid off. I don't want them to just keep increasing debt as their free cash flow goes up. I don't think that's necessarily the most advantageous thing. It might be from a return on invested capital standpoint. If they're able to find rates to grow 20% on the bottom line and the debt only costs you 10%, I mean, you see an arbitrage situation there. But from a risk standpoint, I think you are adding a bit of risk. And so for me, maybe I assume just 10% or so of free cash flow the next couple of years go to debt reduction. The remaining half is roughly split between acquisitions, investments, and then share repurchases. So growth maybe slows to 10% or so, with margins of they're definitely starting to be positive here. I think 10% seems pretty reasonable. It is still pretty close to that gross margin, but with how much growth they've been doing, I think I'm fine with that. I'm definitely making a bit of an assumption here, so maybe give me a little extra return for shared change. 1% for them is about 100 million. Let's just say they offset stock-based compensation. And then majority of that money is going to free cash flow. Over 50% is going to acquisitions and reinvestments. Still growing a lot. I mean, let's say they got to be above market average. Let's do 17. How does that look? Is that too conservative here? So 10% growth rate a year. That's a bit lower than what they've done historically, but again, they've increased their debt $1 billion. So they've definitely leveraged some of this return. 10% on the margin side. They haven't done it on net income side yet. They have done that on free cash flow side. I still think that's pretty high given their gross margin is just 20 to 25% or so. No share change, even though they've historically increased shares a lot based on what I'm seeing and their capital allocation to share purchases, I think can offset stock-based compensation as long as they don't issue more shares. And then a 17P for me, based on their return on invested capital, yeah, their growth is higher on average, but I think return on invested capital maybe not as high. And so I'm dampening down their terminal value with a little bit extra return because, again, some of these things haven't necessarily happened. But still needs to fall 62%. Interesting company. I definitely need to do a lot of research if I were to invest here. But for now, based on this analysis, it's still a bit expensive. Hope you enjoy this video and have a great day.